big bet on the future. The story of SoftBank. September 14, 2017. Masayoshi Son stands before a crowd of investors and reporters in Tokyo, unveiling what he calls the biggest technology fund in human history. The Vision Fund has closed with $97 billion in commitments. Not 97 million. 97 billion. More capital than the entire venture capital industry deployed globally in all of 2016. While other investors carefully construct portfolios of 30 to 50 companies over a decade, spreading risk through diversification, Son will deploy this capital at unprecedented speed and scale. Within 18 months, he will write checks of $100 million or more to over 70 companies. Uber gets 7.7 billion. WeWork gets 4.4 billion. DoorDash, Slack, Fanatics, Compass, Nvidia, Arm Holdings. The list goes on. Single investments larger than most venture capital funds. The strategy seems simple. Identify the winner in each major technology category. Give them so much capital they can overwhelm all competitors. Force consolidation. Create monopolies. Then harvest the returns when these giants go public or get acquired. But this is not courage or vision alone. This is the culmination of 30 years of a specific philosophy refined through triumph and disaster. A belief system forged in the rubble of the dot-com crash when Son lost more money faster than anyone in history. $70 billion of personal wealth evaporating in 2 years. A psychological framework built through recovering from that abyss to become one of the world's richest men. A network constructed over decades that gave him access to Saudi sovereign wealth, Abu Dhabi investment funds, and the world's most valuable startups. While others asked how much is too much, Son asked how much is enough to guarantee victory. This moment reveals everything about what made him different. Not just his appetite for risk, but his fundamental belief that in technology markets, the winner takes everything, and second place is first loser. That if you can identify the right founder building the right product in the right market at the right time, there is no amount too large to invest. That speed and scale create their own competitive advantages. That the network effects of having every major technology company in one portfolio compound in ways that individual investments cannot. But this moment also reveals the seeds of what would become one of the most spectacular value destructions in investment history. Because Son's philosophy, which worked brilliantly in some contexts, would collide catastrophically with others. The very conviction that made him successful would become the source of his greatest failures. The speed that allowed him to win deals would prevent proper diligence. The scale that intimidated competitors would inflate valuations beyond reason. The network effects he counted on would become contagion when portfolio companies started failing. To understand SoftBank and Masayoshi Son, you must understand how someone could be simultaneously so right and so wrong. How the same person who made the greatest venture capital investment in history, turning $130 million into over $100 billion with Alibaba, could also preside over investments that lost tens of billions. How someone could show such patience holding Alibaba for nearly 2 decades, yet such impatience deploying the Vision Fund in 18 months. How he could demonstrate such wisdom in some decisions and such recklessness in others. This is not a story of genius or foolishness. It is a story of conviction pushed beyond its reasonable boundaries. Of a philosophy that worked in one context applied indiscriminately to another. Of a man shaped by specific historical forces, operating in a world that had changed in ways he did not fully appreciate. Of how the very traits that made someone successful in one era became liabilities in the next. The SoftBank story intersects with nearly every major technology transformation of the past 3 decades. The rise of the internet in Japan. The Chinese e-commerce revolution. The smartphone era. The sharing economy. Artificial intelligence. Autonomous vehicles. On-demand delivery. Co-working spaces. Each of these technological waves shaped Son's thinking and was shaped by his capital. But it also intersects with darker themes. The inflation of startup valuations to unsustainable levels. The prioritization of growth over profitability. The concentration of power in a handful of mega funds. the use of capital as a weapon to eliminate competition rather than a tool to build better products. The question of whether Son's approach created value or simply redistributed it from one set of stakeholders to another. To tell this story properly, we must go back to the beginning. To a young man growing up in rural Japan in the 1960s and 70s. To the specific historical forces that made SoftBank possible. To the relationships, failures, successes, and transformations that created one of the most influential investors of the technology age. To understand not just what Masayoshi Son did, but why he could do it when others could not, and why his approach worked when it did and failed when it did not. The world that made Masayoshi Son possible was one of profound transformation and unusual opportunity. When he founded SoftBank in 1981 at age 24, Japan was entering its bubble economy era, technology was becoming accessible to individuals rather than just corporations, and the telecommunications and computing industries were on the verge of convergence that would create entirely new markets. Japan in 1981 was at an extraordinary moment. The post-war economic miracle had transformed the country from devastation to the world's second-largest economy in just 3 decades. Manufacturing excellence had made Japanese products synonymous with quality. Sony, Panasonic, Toyota, Honda had become global brands. The yen was strengthening. Real estate prices were rising. Stock markets were booming. A sense of invincibility pervaded Japanese business culture. But beneath the surface, profound changes were coming. The Plaza Accord of 1985 would dramatically strengthen the yen, making exports more expensive and triggering a shift toward domestic consumption and asset price inflation. By the late 1980s, the Nikkei would reach 39,000, Japanese companies would own Rockefeller Center and Pebble Beach, and 6 of the world's 10 largest banks would be Japanese. Then in 1990, the bubble would burst, beginning 2 decades of stagnation that would come to be known as the lost decades. The technology landscape was equally transformative. Personal computers were just becoming viable consumer products. The IBM PC launched in 1981, the same year Son founded SoftBank. Apple had gone public the previous year, turning early employees into millionaires and proving that technology companies could create enormous wealth quickly. Microsoft was 5 years old and had not yet launched Windows. The Internet existed only as a government research project. Mobile phones were enormous bricks used only by wealthy business people. The venture capital industry barely existed in Japan. American venture capital was itself still young, dominated by a handful of Sand Hill Road firms like Sequoia, Kleiner Perkins, and Mayfield. The model of professional investors providing growth capital to technology companies in exchange for equity was still being refined. In Japan, corporate funding and bank relationships dominated. The concept of entrepreneurship was viewed skeptically in a culture that valued lifetime employment at prestigious corporations. Into this environment came Masayoshi Son, and his background is essential to understanding everything he would later become. Born in 1957 on the southern island of Kyushu, Son was ethnically Korean in a country that discriminated against Korean residents. His family had immigrated to Japan during the colonial period and faced significant prejudice. They lived in poverty, his father running various small businesses including pachinko parlors and restaurants. The family home had no bath and barely any heat. This experience of being an outsider, of facing discrimination, of seeing his parents struggle financially, would shape Son's psychology profoundly. He would later say that feeling like he did not belong gave him the freedom to think differently, to not care about fitting in with Japanese corporate culture, to be willing to fail spectacularly because he had already been rejected by society. The chip on his shoulder would become a source of relentless drive. At age 16, Son convinced his parents to let him move to California to attend high school and eventually the University of California, Berkeley. This decision was itself radical. Few Japanese teenagers studied abroad in the 1970s. The expense was significant for a family of modest means. But Son had become fascinated with American entrepreneurship and technology after reading about McDonald's in a magazine. He wanted to study in the country where individuals could build companies from nothing and become wealthy and successful regardless of family background or ethnicity. At Berkeley in the late 1970s, Son experienced the birth of Silicon Valley. He was there when Apple launched, when the venture capital boom began, when the personal computer revolution started. He met entrepreneurs, read business books voraciously, studied economics and technology, and absorbed the American belief that anything was possible with hard work and the right idea. He also invented and sold to Sharp Corporation a multilingual pocket translator for $1 million while still in college, giving him both capital and confidence. More importantly, Barclay gave Son a vision. He saw that technology was going to transform everything about how humans lived and worked. That the convergence of computing, telecommunications, and eventually the internet would create opportunities of unprecedented scale. That Japan, despite its manufacturing prowess, was behind America in software and entrepreneurship, and that someone who understood both cultures could build a bridge between them. That information itself would become the most valuable commodity, more important than physical goods. He returned to Japan in 1980 with a literal plan written on paper. He gave himself 60 years divided into stages. In his 20s, he would start his business and make his name known. In his 30s, he would accumulate $1 billion in wealth. In his 40s, he would take on a major challenge or fight. In his 50s, he would complete his business empire. In his 60s, he would pass it to the next generation. The grandiosity of this plan, the almost delusional ambition, would characterize everything Son did for the next 40 years. In September 1981, Son founded SoftBank with 2 employees in a small office in Tokyo. The name itself revealed his thinking. Soft for software, bank as a metaphor for being a repository and distributor of information. His initial business was distributing software for personal computers, which were just beginning to penetrate the Japanese market. He was essentially a middleman, connecting American software makers with Japanese retailers and consumers. The business model was simple, but the timing was perfect. As personal computers spread in Japan through the 1980s, someone needed to handle the logistics of getting software to users. Most established Japanese companies viewed software as secondary to hardware. Son saw that software would eventually be more valuable than the machines it ran on, an insight he gained from his time at Barclay watching Microsoft and other software companies emerge. The early years were a grind. Son worked extraordinarily long hours, personally selling to retailers, negotiating with American software companies for distribution rights, handling logistics and inventory. He hired aggressively, looking for young people who shared his vision of technology transforming Japan. He kept overhead low and plowed every yen of profit back into growth. Within 2 years, SoftBank was distributing software from dozens of American companies and had become one of the largest software distributors in Japan. But Son was already thinking beyond distribution. He understood that owning distribution was good, but owning content was better. In 1982, he launched 2 magazines, OPC and OMZ, covering personal computers. This moved SoftBank from just distributing products to creating media that shaped how people thought about technology. The magazines were successful, and Son expanded into other technology publications, building what would become a publishing empire. The magazine business taught Son several lessons that would shape his investing philosophy for decades. First, that information and media businesses had better economics than physical goods distribution, with higher margins and more defensible positions. Second, that brand and trust mattered enormously. People bought magazines from publishers they trusted to give them reliable information and recommendations. Third, that being at the center of information flows gave you advantages in understanding market trends before others. The data from what readers were interested in, what products they were buying, what questions they asked, all provided signals about where technology was heading. By 1984, just 3 years after founding, SoftBank was profitable and growing rapidly. Son had proven he could execute. He had credibility with American technology companies, relationships with Japanese retailers, and a growing media platform. But he remained a small player in a business dominated by much larger companies. He needed to make a leap to the next level. The opportunity came in 1986 when the Japanese government began deregulating telecommunications. For decades, Nippon Telegraph and Telephone had held a monopoly. Now competitors would be allowed to enter the market. Son saw this as the opening he needed. Telecommunications infrastructure was the foundation everything else would build upon. If SoftBank could become a major telecommunications player, it would control access to consumers and businesses as technology became more internet-connected. But entering telecommunications required capital on a scale Sun had never accessed. His software distribution and publishing businesses generated millions in revenue, but not the tens or hundreds of millions needed to build telecommunications infrastructure. This is when Sun made his first major financing decision, a pattern that would repeat throughout his career. He went to banks and raised debt, using his existing businesses as collateral and his vision of the future to convince lenders that telecommunications would generate returns sufficient to service the loans. This early use of leverage, of betting on the future rather than just operating with cash flow from existing businesses, revealed a core element of Sun's psychology. He was always willing to risk everything on his vision. The willingness to borrow heavily, to put the entire company at risk, to bet that his view of the future was correct even when others doubted, this would characterize every major decision he made for the next 35 years. The telecommunications venture had mixed results. SoftBank gained a presence in the market but never achieved the dominant position Sun hoped for. The infrastructure costs were enormous, the competition was intense, and the regulations were complex. By the early 1990s, SoftBank was stretched thin financially, having invested heavily in telecommunications infrastructure while trying to maintain its software and media businesses. Then came the opportunity that would define the first phase of Sun's career and provide the capital for everything that followed. In 1995, Sun met Jack Ma in Beijing. This meeting, which would become one of the most famous encounters in investment history, happened almost by accident. Sun was visiting China exploring opportunities. Ma was a young English teacher and entrepreneur who had just discovered the internet and saw its potential to transform commerce in China. The conventional story, often told by both men, is that Sun decided to invest after just 6 minutes of conversation. This compresses what was actually a longer process, but the core truth is accurate. Sun invested $2 million in Alibaba in 1999 when the company was less than a year old and had no clear business model or revenue. This investment would eventually be worth over $100 billion, making it the most successful venture capital investment in history by absolute dollar returns. But to understand why Sun made this investment, and why it worked so spectacularly, requires understanding both what Sun saw and the broader context of the Chinese internet market at that moment. China in the late 1990s was just beginning to open its economy to market forces after decades of communist central planning. The internet was reaching China, but infrastructure was poor, computers were expensive, and most Chinese had never used the internet. E-commerce barely existed. Amazon was just 4 years old and still only selling books in America. What Sun saw was a market opportunity of unprecedented scale combined with the right founder at the right time. China had over 1 billion people, but almost no retail infrastructure outside major cities. Physical stores required massive capital to build and operate. The internet could, in theory, allow companies to reach consumers anywhere in China without building physical presence everywhere. If someone could figure out how to make e-commerce work in China, they could access a market of 1 billion consumers with relatively low infrastructure costs. But the key was the founder. Ma was not a technologist. He could barely use a computer when Sun met him. But he had several qualities Sun had learned to value through his experience with entrepreneurs. First, Ma understood the problem he was solving at a deeply personal level. He had experienced the difficulty of connecting Chinese manufacturers with overseas buyers during his time running a translation service. He knew that information asymmetry was costing Chinese businesses billions in lost opportunities. Second, Ma was a missionary, not a mercenary. He genuinely believed the internet could transform China, could empower small businesses, could create opportunities for ordinary people. This was not about getting rich quickly, though Ma certainly wanted to succeed financially. It was about a vision of changing society. Sun had learned that entrepreneurs driven by mission beyond money were more likely to persist through the inevitable difficulties of building a major company. Third, Ma had extraordinary charisma and communication ability. He could inspire people to believe in his vision, to join his company, to work for below-market salaries in exchange for equity in something that might become huge. In a market where talent was scarce and competition for engineers was intense, the ability to attract and retain great people was perhaps the most important factor in success. Fourth, Ma was willing to learn. He did not pretend to have all the answers. He asked questions constantly, sought advice, adapted his strategies based on what worked and what did not. Son had seen too many entrepreneurs who were so convinced of their own brilliance that they refused to adapt when the market told them they were wrong. Ma's intellectual flexibility was a huge asset. The investment thesis was simple. If the internet reached China, e-commerce would be enormous. If e-commerce grew in China, there would be a few winners who would capture most of the value. Ma had the best shot of being one of those winners because he understood China, had the right personality to build a company, and was focused on small businesses rather than consumers, a market that would be easier to penetrate initially. The risks were obvious. China's regulatory environment was unpredictable. The government could shut down foreign-backed internet companies at any time. Infrastructure was terrible, with slow internet speeds and expensive computers. Payment systems were undeveloped, most Chinese did not have credit cards. Logistics for delivering products were poor outside major cities. Competition from both Chinese and American companies would be intense. But Son had learned from his time at Barclay that in technology markets, being early mattered more than being right about all the details. If you could identify the right founder in the right market at the right time, many of the obstacles would solve themselves as the market developed. Payment systems would improve because businesses needed them to. Logistics would get better because there was money to be made. Infrastructure would expand because governments and companies would invest in it. This philosophy, that you bet on the right founder in a huge market and then the details work themselves out, would become central to Son's approach. It worked spectacularly with Alibaba. Ma built a company that became one of the most valuable in the world. SoftBank's stake was worth over $100 billion at its peak. The investment returned over 50,000 times the initial capital. But this philosophy also contained the seeds of future problems. Because sometimes the details do not work themselves out. Sometimes the founder is not as capable as he appears. Sometimes the market is not as large as projected. Sometimes the timing is wrong. Sometimes regulatory changes destroy the business model. Sometimes competition is too intense. Sometimes the economics do not work even with perfect execution. Masayoshi Son's early success with Alibaba taught him that his instincts about founders and markets could be trusted. That speed mattered more than exhaustive due diligence. That big visions justified big risks. That having conviction and acting on it decisively was how you made generational returns. These lessons were all true in the specific context of Alibaba in late 1990s China. But Son would later apply them in contexts where they were not true, with catastrophic results. The late 1990s and early 2000s were a period of wild swings for SoftBank, from the peak of irrational exuberance through the crash into the patient value creation that would vindicate Son's vision. The Alibaba investment in 1999 came during the dot-com bubble when capital was flowing into internet companies with almost no scrutiny. SoftBank was both a participant in the bubble's inflation and one of its biggest casualties when it popped. By 2000, SoftBank had invested in hundreds of internet companies, not just in Asia but globally. The strategy was to create a global internet conglomerate, a portfolio of companies that would dominate different segments of the internet economy. E-commerce with Alibaba. Online services with Yahoo Japan. Business-to-business marketplaces with others. The thesis was that the internet would create enormous value and SoftBank wanted exposure to every major opportunity. SoftBank had also invested heavily in Yahoo, the American internet portal and search company. In 1996, SoftBank invested $100 million for roughly one-third ownership. Yahoo was already public, so this was not a venture capital investment in a tiny startup but rather a large bet on a rapidly growing public company. By 2000, at the peak of the bubble, SoftBank's stake in Yahoo was worth billions. Then came the crash. Between March 2000 and March 2002, the Nasdaq fell 78%. Most internet companies went to zero. Yahoo fell 90% from its peak. The valuations that had seemed justified by visions of future growth suddenly looked absurd when investors started demanding actual profits and cash flow. Companies that had raised hundreds of millions ran out of money and shut down. The venture capital industry contracted sharply as LPs refused to commit new capital to funds that had lost everything. For Masayoshi Son personally, this was catastrophic. At the peak in February 2000, his net worth was approximately $78 billion, making him briefly the richest man in the world. By the end of 2002, he had lost approximately $70 billion, the largest individual loss of wealth in history up to that point. SoftBank's market capitalization collapsed from over $200 billion to under $2 billion. The company was close to bankruptcy, unable to service its debts, facing margin calls on loans it had taken out to invest in more internet companies. Most people who lose 90% of their wealth do not recover. The psychological trauma, the humiliation, the loss of confidence, the second guessing of every decision, all combine to make recovery nearly impossible. But Son's response to the crash is essential to understanding his character and his later success. Instead of giving up or playing it safe, he doubled down on his core beliefs. He did not sell Alibaba, even though doing so might have relieved some of the immediate financial pressure. He believed e-commerce in China would eventually be enormous and that Jack Ma would build a great company. The timing had been wrong, the valuations had been absurd, but the fundamental thesis remained valid. He focused on the few investments that had real businesses rather than just dreams. Yahoo Japan, unlike Yahoo in America, had actually built a profitable business serving Japanese internet users. It generated cash flow and could operate independently even if the parent company struggled. Alibaba was still tiny but was beginning to show traction with small businesses in China who were using its platform to connect with buyers. Most importantly, Son used the crisis to learn. He later said that losing that money taught him more than any success ever had. He learned that valuations matter, that you cannot ignore fundamentals forever, that market sentiment can turn instantly and permanently. He learned that liquidity is crucial, that having dry powder when others are forced sellers creates opportunities, but you need the discipline to maintain reserves. He learned that being over-leveraged, borrowing against assets whose value is uncertain, is existentially dangerous no matter how confident you are in your vision. These lessons would stick with him, mostly. He would never again leverage SoftBank to the degree he did in the late 1990s. He would maintain larger cash reserves. He would be more selective about investments, focusing on businesses with real revenue rather than just user growth. But he would not lose his fundamental belief in betting big on the future of technology. He would not become a conservative, diversified investor making small bets across many companies. His core philosophy remained intact. Technology would transform everything. The winners would be enormous. Identifying the right founders and backing them aggressively was the path to generational wealth. The recovery took years. From 2003 to 2006, SoftBank focused on surviving, paying down debt, stabilizing its core businesses. Son sold non-core assets, cut costs, restructured obligations. The company was no longer the high-flying internet conglomerate but rather a struggling telecom and media company trying to avoid bankruptcy. There were no bold new investments, no grand visions, just grinding operational work to stay alive. But by 2006, SoftBank was stable enough to start growing again. And Son had his next big opportunity staring at him. The iPhone was about to launch, initiating the smartphone revolution that would be even bigger than the desktop internet had been. Mobile internet would reach billions of people who never owned computers. Apps would create entirely new categories of products and services. Mobile commerce would dwarf desktop e-commerce. Location-based services would enable businesses that were impossible before. The platforms that controlled mobile ecosystems, iOS and Android, would become the most valuable companies in the world. Son saw all of this early and positioned SoftBank to benefit. In 2006, before the iPhone even launched, SoftBank acquired Vodafone Japan for $15 billion, giving it control of one of Japan's major mobile carriers. This was a huge bet, the largest acquisition SoftBank had ever made, requiring enormous debt that put the company at risk again. But Son believed mobile would be transformative and wanted to control the infrastructure layer that consumers would access mobile services through. The timing was perfect. When the iPhone launched in 2007, SoftBank was the exclusive carrier in Japan, giving it access to the most desirable customers who wanted the revolutionary new device. This drove subscriber growth and positioned SoftBank as the innovative carrier while competitors were stuck with traditional feature phones. The mobile business became enormously profitable, generating billions in cash flow annually that Son could use to fund his next wave of investments. Meanwhile, Alibaba was growing explosively. By 2007, it had become the dominant e-commerce platform in China with Taobao, its consumer marketplace, crushing eBay, which had tried to enter China. It had launched Alipay, a payment system that solved the trust problem in online transactions. It was generating real revenue and profit, not just user growth. Jack Ma had proven he could build a real business, not just an inflated valuation. In 2007, Alibaba did something unusual. Instead of going public, which would have allowed SoftBank to sell shares and realize gains, Ma took the company private by having the shareholders buy out Yahoo's stake. This gave Ma more control and flexibility to build the business without quarterly earnings pressure. SoftBank maintained its stake, continuing to bet on long-term value creation rather than cashing out. This patience, this willingness to hold an investment for a decade or more, stands in stark contrast to Son's later behavior with the Vision Fund. With Alibaba, he had learned that truly great companies take time to build, that staying private longer allows founders to focus on building rather than managing public market expectations, that the big money comes from holding winners for decades, not flipping them quickly. By 2014, Alibaba finally went public in what was then the largest IPO in history, raising $25 billion at a $74 share price that valued the company at $168 billion. SoftBank's stake was worth $58 billion. On paper, Son had made back all the money lost in the dot-com crash and then some. The validation was complete. His vision had been correct. The execution had taken 15 years and required surviving near bankruptcy, but the outcome justified the faith. This is when the story takes its fateful turn toward the Vision Fund and the decisions that would make Son simultaneously one of the most successful and most controversial investors of the 2010s. Because the Alibaba success taught Son that his instincts were correct, that betting big on transformative founders worked, that patience paid off. But it did not teach him the limits of this approach or the ways that context mattered. It did not teach him that what worked with one exceptional founder in one extraordinary market at one unique moment in history would not work if deployed indiscriminately across dozens of companies in mature markets where the dynamics were completely different. The Vision Fund, announced in October 2016 and closed in May 2017 with $97 billion in commitments, was unlike anything the investment world had ever seen. To understand its creation and strategy requires understanding both Son's motivations and the specific market conditions that made it possible. Son was now 60 years old, approaching the stage in his 60-year plan where he would complete his business empire. He had succeeded spectacularly with Alibaba, but that was one investment. He wanted to prove he could do it repeatedly, at scale, across multiple technologies and geographies. He also had a specific thesis about artificial intelligence. Son believed AI would be the most transformative technology in human history, bigger than the internet, bigger than mobile. He believed the companies that won in AI would be worth trillions of dollars. And he believed the winners would be determined in the next 5 to 10 years. Whoever got to scale first, whoever had the most data to train their algorithms, whoever could deploy AI across the most use cases, they would build insurmountable advantages that would last for decades. This thesis was not crazy. Many smart people shared this view of AI's importance. What was unique about Son was his conclusion about investment strategy. He believed that if AI would create trillions in value and the winners would be determined quickly, then there was essentially no price too high to pay to back the likely winners. A company that might be worth $1 trillion in 10 years was cheap at any valuation under $100 billion. Speed mattered more than price. Scale mattered more than profitability. Market share mattered more than margins. This led to a strategy of deploying capital at unprecedented speed and scale. The Vision Fund would identify the leading company in each major technology sector. ride-sharing, food delivery, real estate, robotics, e-commerce in specific geographies, autonomous vehicles, semiconductors, prop tech, fintech, edtech. Then it would invest so much capital in the leaders that they could overwhelm all competitors. The capital would allow them to subsidize prices below cost, expand faster than rivals, hire away the best talent, outspend everyone on marketing, weather any downturn, force consolidation, and ultimately achieve dominant positions. The model was Alibaba. Use capital to help the best founder in a huge market achieve dominance. But instead of one Alibaba per decade, Son wanted to create dozens of category-defining companies simultaneously. The Vision Fund would become a portfolio of monopolies, each in a different sector but all benefiting from AI and network effects. The returns would be enormous because monopolies are extraordinarily valuable. Markets might pay 50 times revenue for a company that has 80% market share and growing, even if it loses money currently, because the long-term profits from a monopoly position justify any near-term losses. To execute this strategy, Son needed unprecedented amounts of capital. No traditional venture capital fund was large enough. The largest VC funds were $3 to $5 billion, and they deployed that capital over 4 to 5 years across 100-plus companies. Son needed 10 times that much capital and wanted to deploy it 10 times faster into much fewer companies. He needed patient capital that would not demand returns for a decade, that understood the bets would take time to pay off, that could handle the volatility of massive concentrated positions. He found this capital in sovereign wealth funds. Saudi Arabia's public investment fund committed $45 billion. The Mubadala Investment Company of Abu Dhabi committed $15 billion. SoftBank itself committed $28 billion. Apple, Qualcomm, Sharp, and others committed smaller amounts. These were not traditional limited partners who invested across many venture capital funds seeking diversification. These were single large institutions making a massive bet on Son's vision. The decision by Saudi Arabia to commit $45 billion, nearly half the fund, is worth examining because it reveals both the opportunity and the risks. Crown Prince Mohammed bin Salman was trying to diversify Saudi Arabia's economy away from oil. He saw technology as the future and wanted Saudi capital to be part of it. But Saudi Arabia had limited expertise in technology investing. Its sovereign wealth fund had historically invested in more traditional assets like real estate, public equities, and infrastructure. Son convinced MBS, as he was known, that the future returns would come from technology and that SoftBank had unique expertise in identifying and supporting technology winners. He pointed to Alibaba as proof. He described his vision of AI transforming everything. He offered a simple proposition. Give SoftBank $45 billion and in 10 years it will be worth several times that amount as these technology companies go public or get acquired. The returns will help fund Saudi Arabia's transformation while the kingdom gains access to cutting-edge technology companies that might be strategically valuable. For MBS, this was appealing. He wanted to be seen as a modernizer transforming Saudi Arabia. Investing in technology through the world's most successful technology investor fit that narrative. The potential returns would help fund his ambitious domestic programs. And he would gain relationships with founders and companies that might provide technology to help Saudi Arabia's development. But there were obvious risks that neither party fully appreciated. Sovereign wealth funds have different incentives than traditional venture capital LPs. They are often driven as much by political and strategic considerations as by pure financial returns. They may have less patience for losses if those losses become politically embarrassing. They may want more control over how capital is deployed, especially if they disagree with specific investments. They may withdraw support suddenly if political winds change. Additionally, taking money from Saudi Arabia would create controversy and reputational risk for SoftBank and its portfolio companies. Human rights concerns, the murder of journalist Jamal Khashoggi in 2018, the war in Yemen, all would become associated with companies that took SoftBank money. Some founders would refuse SoftBank investment because of the Saudi connection. Some employees would quit portfolio companies when they learned about the funding source. The reputational cost would be significant even if never quantified precisely. But in mid-2017, these concerns seemed minor compared to the opportunity. Son had nearly $100 billion and a mandate to deploy it quickly into the best technology companies. He assembled a team, but the team was small relative to the capital. Traditional venture capital firms have dozens of partners and associates doing due diligence, competitive analysis, reference checks, financial modeling. The Vision Fund had perhaps 20 investment professionals trying to deploy $100 billion. That worked out to over $4 billion per person, an impossible amount for proper evaluation. The deployment strategy reflected this capacity constraint. Rather than spending months on due diligence for each investment, the Vision Fund often moved in weeks. Son would meet with founders, get excited about their vision, and commit to investments of $100 million to several $1 billion after relatively little diligence. He relied heavily on his instincts, his pattern recognition from decades of investing, his assessment of founder quality, and his view of market size. This approach worked brilliantly in some cases and catastrophically in others. The difference came down to whether the fundamental business model was sound and whether the founder was actually capable of execution at scale. When both conditions were met, the capital accelerated growth and created dominance. When either condition was absent, the capital allowed founders to scale broken business models or revealed their inability to manage large, complex organizations. The first major test came with Uber. In January 2018, SoftBank led a consortium that invested $7.7 billion in Uber at a $72 billion valuation. This was by far the largest investment in a private company in history. To put that number in perspective, $7.7 billion was more than most venture capital firms managed in total across all their funds. It was more than the entire GDP of some countries. It was enough money to have built something completely new rather than investing in an existing company. The investment thesis for Uber was straightforward. Ride-sharing was becoming a major part of urban transportation. Uber was the clear leader in most global markets. The company had over 3 billion rides annually and was growing rapidly. If Uber could achieve profitability at scale, it would be worth hundreds of billions as it became the default transportation option for billions of people globally. The losses it was currently running, over $4 billion annually, were investments in growth and would eventually turn positive as the business matured and competition consolidated. Moreover, Uber was positioning itself for autonomous vehicles. When self-driving cars became viable, Uber's massive network of riders and drivers would give it a unique advantage in deploying them. The economics of ride-sharing would transform once the driver was removed, with margins expanding dramatically. Any company that wanted to deploy autonomous vehicles at scale would need Uber's infrastructure, giving it a strategic position that justified almost any valuation. But there were significant concerns that the Vision Fund overlooked or dismissed. First, Uber's core business had questionable unit economics. The company subsidized rides heavily to attract riders and drivers. It was not clear that customers would continue using Uber at prices high enough to cover costs without subsidies. Every analysis of Uber's profitability seemed to assume that someday the subsidies would end and customers would pay full price, but there was little evidence this would actually happen. Second, competition was intense and showed no signs of abating. Lyft in the US, Didi in China, Ola in India, Grab in Southeast Asia, all were well-funded and growing. The Vision Fund's strategy of giving Uber overwhelming capital advantage only worked if competitors could not access capital. But they could. SoftBank itself had invested in several of Uber's competitors, creating conflicts and questions about whether it was playing companies against each other. Third, regulatory risk was enormous and growing. Cities around the world were reconsidering whether ride-sharing should be allowed, what regulations should apply, whether drivers should be employees rather than contractors. Any change in regulatory treatment could fundamentally alter the economics. The Vision Fund's investment essentially assumed that regulatory frameworks would remain favorable or at least neutral. Fourth, the company culture was toxic and getting worse. Travis Kalanick, the founder and CEO, had created an aggressive, win-at-all-costs environment that had led to numerous scandals. Sexual harassment, intellectual property theft, using software to evade regulators, threats against journalists who wrote critical stories. By the time SoftBank invested, Kalanick had already been forced out as CEO after the board lost confidence in his leadership. The new CEO, Dara Khosrowshahi, was capable but inherited enormous cultural and operational problems. Fifth, and perhaps most importantly, autonomous vehicles were much further away than the investment thesis assumed. The technology was harder than anticipated. Regulatory approval would take longer. Consumer acceptance was uncertain. The timeline for removing the driver from the equation kept getting pushed back. If autonomous vehicles were 10 or 20 years away rather than 3 to 5, then Uber's current losses were not investments in a transition period but rather a permanent feature of the business model. Despite these concerns, SoftBank proceeded with the investment, and for a while it looked smart. Uber's revenue continued growing. The company prepared for an IPO. The narrative that Uber would become the transportation operating system for cities gained traction. Other investors wanted in at higher valuations. By early 2019, Uber was preparing to go public at a valuation over $100 billion. Then reality intruded. When Uber actually went public in May 2019, investors were not willing to value it at $100 billion. The IPO priced at $45 per share for an $82 billion valuation, below the SoftBank investment. The stock immediately fell below the IPO price and continued falling, losing over 30% in the following months. Public market investors looked at the financials and concluded the growth was not worth the losses, the competitive dynamics were not improving, the path to profitability was unclear. The Vision Fund stake, which cost $7.7 billion at $72 billion valuation, was now underwater. And it would get worse. By March 2020, during the COVID pandemic, Uber stock fell below $25, valuing the company at $40 billion, almost half what SoftBank had paid. The Vision Fund had lost several $1 billion on paper on what was supposed to be its flagship investment. The Uber investment revealed several problems with the Vision Fund strategy. First, valuation matters. Paying $72 billion for something that public markets value at $40 billion is not patient long-term investing. It is overpaying. The argument that valuation does not matter for category-defining companies only holds if they actually become valuable enough to justify the price. If they do not, you lose money no matter how good the company is. Second, capital cannot solve fundamentally flawed unit economics. Uber's problem was not lack of capital. It had raised over $20 billion before going public. Its problem was that the business model might not work at the scale required to justify the valuations investors had assigned. Giving it more capital to subsidize more rides just increased the total losses without proving the model worked. Third, being the biggest investor does not give you control in ways that matter. SoftBank had enormous influence at Uber through its board seats and shareholding. But it could not fix the cultural problems, force the company to profitability, or accelerate autonomous vehicle technology. The founders and management still ran the company day to day. Large shareholders can encourage or pressure, but they cannot operate. Fourth, the Vision Fund strategy of investing in the leader in each category meant it often invested late at high valuations. Uber had been around 9 years by the time SoftBank invested. It was already a $50 billion company before the investment. The opportunity to buy low and benefit from growth from small to large was gone. The Vision Fund was essentially betting that a large company would become even larger, that 50 would become 500. But most of the value creation in venture capital comes from 0 to 1 or 1 to 10, not from 10 to 100. The WeWork investment was even more problematic and ultimately more costly. In August 2017, SoftBank invested $4.4 billion in WeWork, valuing the company at $20 billion. Over the next 2 years, it would invest another $6 billion across multiple rounds, ultimately valuing the company at $47 billion by January 2019. This made WeWork one of the most valuable private companies in the world and SoftBank its largest investor with over 50% ownership. The investment thesis was that WeWork was a technology company transforming real estate, not just a real estate company. Traditional commercial real estate was inefficient. Companies signed long-term leases, built out spaces, then adjusted headcount up or down while stuck with fixed real estate costs. WeWork would solve this with flexible short-term leases, beautiful communal spaces, and community that made work better. The target market was not just startups but increasingly large corporations that wanted flexibility. The addressable market was in the trillions, essentially every office worker in the world. Moreover, WeWork was positioning itself as a platform. It had data on how people used space, what amenities mattered, what made workers productive. It could use this data to design better spaces, price dynamically, expand into other real estate categories like living spaces and education. The vision was WeWork as the operating system for physical space, analogous to what iOS and Android did for mobile. Adam Neumann, WeWork's charismatic founder and CEO, sold this vision brilliantly. He convinced Son that WeWork would be worth several $100 billion, that it was growing faster than Amazon or Google had at similar stages, that the company would redefine how humans worked and lived. Son was captivated by Neumann's vision and convinced this was another Alibaba, another chance to back an exceptional founder building something transformative. But almost nothing about this thesis held up under scrutiny. WeWork was not a technology company. It was a real estate company with a website. The core business model was simple arbitrage. WeWork signed long-term leases with landlords at one price, then subleased to customers at higher prices on flexible short-term terms. When times were good, this worked. When occupancy was high and prices were rising, WeWork could charge enough to cover its costs plus overhead plus provide returns to investors. But the model was inherently risky because of the mismatch between long-term commitments and short-term revenue. If the economy weakened and customers left, WeWork still owed rent to landlords on its long-term leases. Traditional real estate companies understood this risk and were conservative about how much space they leased. WeWork, flush with SoftBank capital, was expanding as fast as possible, signing leases for millions of square feet without proving the model worked at scale. The unit economics were questionable even in good times. WeWork's revenue per square foot was not actually higher than traditional office space once you accounted for the services and amenities it provided. Its costs were higher because of the beautiful build-outs and communal spaces. The promised operating leverage, where each additional location would be more profitable than the last, was not materializing. Instead, each new location seemed to lose money until it reached high occupancy, which took longer than projected. The overhead was extraordinary. WeWork was spending enormous amounts on marketing, corporate staff, technology development, and Adam Neumann's personal expenses. The company employed thousands of people in headquarters, far more than a real estate company of similar size would need. The burn rate, over $2 billion annually by 2019, was staggering for a company that was just leasing and operating office space. Most concerning was Neumann himself. The Vision Fund's bet was fundamentally on Neumann's capability to execute at massive scale. But Neumann had never run a large company. He had no experience in real estate beyond WeWork. He had no background in technology. His management style was erratic, making decisions impulsively, reversing course frequently, creating chaos for employees trying to execute. Worse, Neumann was treating the company as his personal fiefdom. He had bought buildings and then leased them to WeWork, making money from his own company. He had taken loans from WeWork at favorable terms. He held voting control through special shares, meaning no one could remove him even if the company failed. He was using corporate funds for personal expenses, including private jet travel and a rumored purchase of a wave pool company that had nothing to do with WeWork's business. All of this was knowable at the time of SoftBank's investment. Public filings when WeWork prepared to go public would later reveal much of this behavior. But even in 2017 and 2018, there were red flags visible to anyone doing serious diligence. Industry insiders knew WeWork's economics were questionable. Real estate experts were skeptical of the valuation. Former employees were sharing stories of Neumann's erratic behavior. The Vision Fund either did not do the diligence necessary to uncover these issues or did the diligence and chose to ignore the findings because Son was so enamored with Neumann and the vision. Either way, it was an enormous failure of investment process. You cannot invest $10 billion in a company without understanding its fundamental business model, verifying its unit economics, checking the founder's background and behavior, talking to competitors and customers and former employees to understand what is actually happening. The situation came to a head in August 2019 when WeWork filed to go public. The S-1 filing, which publicly disclosed the company's financials and governance structure for the first time, was a disaster. Public market investors read it and recoiled. The losses were even larger than suspected. The governance was even worse. Newman's conflicts of interest were extensive. The business model made no sense at the proposed valuation. Within weeks of filing, WeWork's IPO collapsed. The company tried to go public at $47 billion. The market said it was worth maybe $15 billion, maybe less. Institutional investors who reviewed the S-1 concluded the company might not be viable at all without massive additional capital injections. They questioned whether the business model could ever be profitable. They were horrified by Newman's governance and behavior. In September 2019, WeWork pulled its IPO. Days later, Newman was forced to resign as CEO. SoftBank, which had already invested $10 billion and was by far the largest shareholder, faced a choice. It could walk away, write off the investment, let the company fail. Or it could invest billions more to keep WeWork alive, taking full control and trying to fix the problems. SoftBank chose the latter, investing another $5 billion in October 2019 to stabilize the company and buy out many earlier investors including Newman himself, who would receive $1.7 billion for his shares while giving up control. This brought SoftBank's total WeWork investment to approximately $15 billion for control of a company that was losing billions annually and might be worth nothing. The decision to double down rather than walk away is worth examining. Son explained it as protecting SoftBank's investment. Having already invested $10 billion, the company was too big to fail from SoftBank's perspective. If WeWork collapsed, it would devastate the Vision Fund's returns and Son's reputation. Better to invest another $5 billion trying to fix it than accept a total loss on the first $10 billion. But this reasoning reveals flawed thinking. It treats sunk costs as relevant to future decisions. The $10 billion already invested was gone whether SoftBank invested more or not. The question should have been, is this company worth $5 billion more of new money? Will investing more fix the fundamental problems? Can WeWork ever be profitable enough to justify $20 billion in total investment? The honest answer to all these questions was probably no. WeWork's problems were not fixable with more capital. The business model was flawed. The liabilities from long-term leases were enormous. The reputation was destroyed. Corporate customers were reconsidering whether to do business with a company in chaos. The best-case scenario was probably that WeWork could shrink, cut costs, eventually become a small profitable company worth a few billion. But it would never be worth $47 billion, let alone the hundreds of billions Newman and Son had envisioned. By mid-2020, during COVID, WeWork's situation was dire. The pandemic sent everyone home, office occupancy collapsed, companies cancelled their WeWork memberships. The company was hemorrhaging cash and facing bankruptcy. SoftBank had to inject billions more just to keep the doors open. By the time WeWork finally went public in 2021 through a SPAC merger, it was valued at $9 billion, less than half what SoftBank had invested and less than 20% of the peak private valuation. As of early 2025, WeWork's market cap has fallen to under $1 billion. SoftBank's total losses on WeWork exceed $15 billion. This is one of the largest single investment losses in history. It is also one of the most avoidable. Every part of the thesis was flawed from the beginning. The company was not special. The founder was not capable. The business model did not work. The valuation made no sense. If SoftBank had done proper diligence, if Son had listened to skeptics, if the Vision Fund had imposed basic standards of governance and financial discipline, this disaster could have been prevented. The WeWork failure revealed the deepest problems with the Vision Fund's approach. First, the belief that capital alone creates dominance. WeWork had access to more capital than any competitor. But capital did not fix the broken business model. It just allowed WeWork to scale the losses faster. Second, the danger of founder worship. Son was so convinced Newman was a visionary that he ignored obvious red flags. Charisma is not the same as competence. Vision without execution is just dreaming. Great founders need to be evaluated on their ability to build organizations, develop products, understand customers, manage finances, and grow themselves as the company scales. Newman failed on all these dimensions. Third, the problem of concentrated bets without rigorous diligence. Investing $15 billion in one company requires being absolutely certain the thesis is correct. The Vision Fund moved too fast, relied too much on Son's intuition, and did not have the systematic processes that successful investors use to avoid disasters. Fourth, the governance failure. SoftBank controlled WeWork but did not use that control to impose discipline until it was too late. The board let Newman run wild because they trusted Son's judgment and did not want to interfere with a visionary founder. This is exactly backward. More control demands more responsibility to ensure good governance. The combination of Uber and WeWork, two of the Vision Fund's largest investments, both losing billions, fundamentally changed the narrative around SoftBank and Son. What had been portrayed as visionary investing now looked like reckless deployment of capital. The success with Alibaba seemed like luck rather than skill, a one-time win, not a repeatable formula. The $97 billion Vision Fund, which was supposed to generate huge returns and cement Son's legacy, was instead destroying value on a historic scale. But the story does not end there, because the Vision Fund's portfolio contained dozens of other investments, some successful and some not, and the pattern across these investments reveals even more about what worked and what did not in Son's approach. DoorDash is an example of an investment that ultimately worked, though with significant volatility along the way. SoftBank invested over $600 million across multiple rounds from 2018 to 2020, valuing the company at various points from $7 billion to $16 billion. DoorDash was in the food delivery business, competing with Uber Eats, Grubhub, and Postmates. The market was growing rapidly as consumers increasingly ordered food for delivery rather than picking it up or eating at restaurants. The unit economics were challenging but better than ride-sharing because restaurants paid commissions and customers paid delivery fees, and the average order value was higher than a typical ride. DoorDash's advantage was operational execution. While competitors had better brand recognition, DoorDash figured out how to serve suburban and mid-sized markets that others ignored. It built technology to optimize delivery routing. It provided better support to restaurant partners. By 2020, it had become the market leader in the US with around 50% market share. The COVID pandemic accelerated the business as restaurants closed dining rooms and relied on delivery for survival. When DoorDash went public in December 2020, it was valued at $72 per share for a market cap of $38 billion. SoftBank's stake was worth over $9 billion, a multiple of over 10 times on its investment. This looked like exactly the kind of outcome the Vision Fund was supposed to generate. Back the leader in a big category, give them capital to achieve dominance, harvest returns when they go public at a much higher valuation. But even this success illustrates the problems with the strategy. First, SoftBank invested late at high valuations. It was not an early backer when the risk was highest and the valuations were lowest. It invested when DoorDash was already worth billions and was an obvious leader. The multiple was good but not spectacular because the entry price was already high. Second, the ultimate success depended significantly on COVID, an unpredictable external shock that happened to benefit food delivery enormously. Without COVID, DoorDash's growth might have been much slower and the IPO timing and valuation might have been much less favorable. Third, the competitive dynamics meant the company was still not profitable at scale. Food delivery as a category struggled with unit economics, and it was not clear if anyone would ever make good returns on capital invested. By late 2021, when SoftBank needed to sell to generate returns for Vision Fund investors, DoorDash's stock had risen to over $200. SoftBank's stake was worth over $20 billion. But Son chose not to sell, believing the company would continue growing and the stock would go higher. By late 2022, after broader market declines and concerns about DoorDash's profitability, the stock had fallen back to around $40, valuing SoftBank's stake at under $4 billion, less than the cost basis. As of early 2025, DoorDash trades around $170 and SoftBank has still not sold most of its position. This pattern of unrealized gains turning into losses because of holding too long repeats across the portfolio. The Vision Fund was structured as a typical private equity fund with a 10-year life, meaning it needed to return capital to investors within 10 years of investing. But Son kept holding winning positions hoping they would appreciate more, turning paper profits into paper losses when markets turned. This is the opposite of the discipline that made Sequoia and other great investors successful. They sold winners early, taking chips off the table, realizing gains, returning capital to LPs who could reinvest elsewhere. The Vision Fund wanted to capture every dollar of upside, which meant capturing every dollar of downside too when markets reversed. The portfolio also included numerous failures beyond Uber and WeWork. Brandless, a direct-to-consumer products company, shut down completely, losing SoftBank $240 million. Fair, a car subscription service, went bankrupt, losing $380 million. Katera, a construction company, went bankrupt, losing over $2 billion. Zoom Pizza, a robot pizza-making company, shut down, losing over $400 million. Greensill Capital, a supply chain finance company, collapsed spectacularly, losing $1.5 billion. The pattern was similar in each case. SoftBank invested at high valuations. The company used the capital to grow quickly, but the unit economics did not work. Competition was intense. The business model was flawed from the beginning. The question is how so many obviously broken companies ended up in the portfolio. The answer is speed and scale. The Vision Fund was deploying billions per quarter. It could not possibly do proper diligence on every company. It relied on Son's instincts, on quick assessments of founder quality and market size, on the belief that capital and conviction could overcome problems. This works occasionally but fails most of the time. By late 2020, as the Vision Fund's problems became undeniable, SoftBank's stock price had fallen to multi-year lows. The company was trading at less than half its net asset value, meaning the market valued SoftBank itself as worth less than zero, with its operating businesses and cash worth more than the total market cap. This discount reflected investors' belief that Son would continue destroying value through bad investments, that the Vision Fund was a liability not an asset, that SoftBank's conglomerate structure made it impossible to realize the value of its holdings. Son's response was to announce Vision Fund 2, raising $50 billion for a second fund that would repeat the strategy. This was remarkable timing because it came just as Vision Fund 1's problems were becoming clear. Very few limited partners committed to Vision Fund 2. Without extensive outside capital, the fund was mostly SoftBank's own money plus some small commitments from others. This meant Son could continue investing, but the returns would primarily affect SoftBank's balance sheet rather than generating fees and carry from outside investors. Through 2020 and 2021, Vision Fund 2 invested in dozens more companies using similar logic as the first fund. Late-stage growth equity, large check sizes, high valuations, emphasis on AI and technology transformation, conviction that capital and scale would create dominance. Some investments were in companies that went public successfully. Some were in companies that are still private. Some were in companies that failed quickly. The ultimate returns are not yet clear because most positions are still held. What is clear is that the strategy has not generated the returns initially promised. Vision Fund 1, which invested $97 billion from 2017 to 2019, has generated poor returns for its LPs. The exact numbers are not public because SoftBank is a private fund and does not disclose detailed performance. But based on public market valuations of portfolio companies that have gone public and reported write-downs of companies that failed, most analyses suggest the fund has returned less than 1 times capital to investors, meaning LPs would have been better off investing in index funds rather than giving money to SoftBank. For SoftBank itself, which committed $28 billion of its own capital to Vision Fund 1, the results are even worse when accounting for opportunity cost. The capital could have been invested in other things or returned to shareholders. Instead, it was deployed into a portfolio of assets that collectively have not appreciated much if at all after accounting for the failures. The crown jewel of the portfolio that kept SoftBank afloat was Arm Holdings, the British semiconductor design company that SoftBank acquired in 2016 for $32 billion. Arm designs the processor architectures used in most smartphones and increasingly in servers and other devices. It licenses these designs to companies like Apple, Qualcomm, and Samsung, collecting royalties on every chip produced. The business is highly profitable with gross margins over 95%, strong network effects, and essential intellectual property. SoftBank's ownership of Arm gave it credibility in the technology industry and provided steady cash flow from Arm's operations. But it also created problems because SoftBank tried to use Arm for financial engineering that did not benefit Arm's business. The company attempted to sell Arm to Nvidia for $40 billion in 2020, a deal that would have generated profits for SoftBank but faced regulatory objections and was ultimately abandoned. Then SoftBank took Arm public in September 2023 at $51 per share for a $54 billion valuation. The Arm IPO was modestly successful for SoftBank. The company sold about 10% of its stake, raising several $billion while retaining 90% ownership. The public markets valued Arm higher than the Nvidia deal would have, so on paper SoftBank's stake was worth over $45 billion, up from the $32 billion paid in 2016. But this was not a spectacular return for 7 years of ownership, representing a compound annual growth rate of under 5%, far below what technology stocks generally returned over the same period. Moreover, SoftBank's ownership arguably held Arm back. Under private ownership, Arm could not use its stock for acquisitions or employee compensation as effectively as public company competitors. Its strategic options were limited. There was always speculation that SoftBank would sell Arm to raise cash for other investments or to pay down debt, creating uncertainty for employees and partners. If Arm had remained independent or been owned by a more natural corporate parent, it might have grown faster and been worth more. The Arm story illustrates a broader point about SoftBank's portfolio. The company's best assets were ones it did not actively manage but just held. Alibaba was successful because Jack Ma ran it brilliantly and SoftBank stayed out of the way. Arm was successful because it was a good business before SoftBank bought it and continued being well run after. The Vision Fund investments, where SoftBank was actively involved in strategy and governance, were far less successful on average. This suggests that Son's skill was not in operating businesses or even in working closely with founders to improve operations. His skill was in identifying great businesses early and holding them for a long time. The Alibaba investment in 1999 was early and at a low valuation. The hold for 15 years allowed the business to mature and capture enormous value creation. This model worked. The Vision Fund model of late-stage investing at high valuations, deploying capital quickly without deep diligence, holding concentrated positions in companies with questionable unit economics, this model did not work. It destroyed value rather than creating it. The difference was not Son's capabilities but the strategy itself. Early-stage venture capital can generate high returns because you are buying ownership in companies worth almost nothing that might become worth billions. Late-stage growth equity can generate returns if you are disciplined about valuations and selective about companies. But deploying tens of billions at whatever price the market will bear into companies that are already worth billions, without proving they can be profitable, this is a strategy for losing money. By 2022 and 2023, as public markets declined and technology valuations contracted, the Vision Fund's problems became existential for SoftBank. The company's market cap fell to around $60 billion even though its holdings in Alibaba and Arm alone were worth over $100 billion. This extreme discount reflected investor belief that Son would continue making bad investments that would offset the value of the good assets. SoftBank had another problem, which was leverage. The company had borrowed extensively against its holdings to fund investments and operations. When the value of those holdings fell, the loan-to-value ratios increased, triggering margin calls and forced asset sales. In 2020, SoftBank was forced to sell $41 billion of assets, including significant parts of its Alibaba and SoftBank stake, to raise cash and reduce debt. This destroyed long-term value to solve short-term liquidity problems, exactly the situation Son had experienced in the dot-com crash and vowed never to repeat. The forced selling also occurred at terrible times. SoftBank was selling Alibaba in 2020 and 2021 when the stock was depressed due to Chinese regulatory crackdowns on technology companies. It was selling near the bottom, locking in losses. If the company had not been leveraged, it could have held through the volatility. But the debt forced sales regardless of whether the timing was good. This pattern repeated across the portfolio. SoftBank owned 25% of Alibaba, worth over $100 billion at peak valuations in 2020. By late 2022, that stake was worth under $40 billion as Alibaba's stock fell 70%. SoftBank had sold down its ownership from 25% to under 4%, mostly at unfavorable prices. The company that had generated its greatest success was now largely monetized, the long-term value given up to solve short-term problems created by the Vision Fund's failures. The same happened with T-Mobile, where SoftBank owned a large stake from its Sprint merger. The company sold most of the stake in 2020 and 2021. And with numerous other holdings. The strategy of deploying capital quickly into risky investments, funding those investments with debt, then being forced to sell good assets when the risky investments failed, this was value destruction on a systematic level. By early 2025, SoftBank's situation has stabilized somewhat. The company is less leveraged. The Vision Fund has slowed deployment significantly. Some portfolio companies have recovered as public markets rebounded. Arm has performed well since going public. The existential crisis has passed. But the fundamental questions remain unanswered. What is SoftBank? Is it an investment company, a telecommunications business, a technology conglomerate? What is its strategy? Will it launch Vision Fund 3 and repeat the same mistakes? Can it regain the trust of investors and founders after the disasters of the past several years? Son's legacy is mixed and still being written. On one hand, he made the single best venture capital investment in history with Alibaba. He helped build Japan's telecommunications infrastructure. He backed dozens of important technology companies that created products used by billions of people. He brought enormous amounts of capital into technology investing, helping fund innovation that might not have happened without that capital. On the other hand, he destroyed tens of billions of dollars through reckless late-stage investing. He inflated valuations across the technology industry, making it harder for companies to achieve sustainable business models. He enabled bad actors like Adam Neumann to build toxic companies. He took money from controversial sources like Saudi Arabia, entangling technology companies with regimes criticized for human rights abuses. He used leverage irresponsibly, creating risks that hurt stakeholders. The lessons from SoftBank's story cut across multiple dimensions of investing, business building, and human behavior. For investors, the most important lesson is that strategy and context matter as much as skill or vision. Son's approach of backing exceptional founders in huge markets at early stages with patient capital worked brilliantly with Alibaba. But the same philosophy applied to late-stage companies at high valuations with impatient capital failed catastrophically. Knowing when a strategy works and when it does not is as important as having a strategy at all. Second, valuation always matters eventually. The Vision Fund's belief that you could ignore valuation for category-defining companies was wrong. Every investment is a bet that the price you pay is justified by the future cash flows the business will generate. If the price is too high relative to plausible outcomes, you lose money even if the company succeeds. This is basic finance, but the Vision Fund forgot it in the excitement of deploying capital at scale. Third, due diligence cannot be shortcut no matter how confident you are. Son's instincts and pattern recognition were valuable but not sufficient. The largest investments required the deepest analysis, not the fastest decisions. Professional investors spend months on due diligence for good reason. They check references, verify claims, test assumptions, talk to competitors and customers, model different scenarios, identify risks. The Vision Fund skipped much of this because it wanted to move fast, and the results were predictable. Fourth, governance matters more as investments get larger. Small investments can fail without destroying a portfolio. Billion-dollar investments require excellent governance to protect the capital. This means proper board oversight, financial controls, management accountability, alignment of incentives. The Vision Fund often took board seats but did not use them to impose discipline, allowing founders to make bad decisions that destroyed value. Fifth, leverage magnifies both successes and failures and usually ends badly. SoftBank's use of debt to fund investments meant the downside was catastrophic when things went wrong. In finance, the optimal amount of leverage is usually less than you think. The extra returns from leverage in good times are offset by the destruction from forced selling in bad times. Son learned this in the dot-com crash but forgot it again when conditions were favorable. Sixth, speed is sometimes the enemy of good outcomes. The Vision Fund's pace of deployment prevented proper evaluation of opportunities. Fast decisions make sense when you have conviction and the situation demands urgency. But deploying $100 billion in 18 months is not urgent. It is reckless. The capital would still be there in 3 or 5 years. Waiting for good opportunities rather than manufacturing urgency would have generated far better returns. Seventh, concentrated portfolios require being right. The Vision Fund put billions into individual companies, creating enormous concentration risk. This only makes sense if the due diligence and conviction justify it. For most of the Vision Fund's investments, the diligence was insufficient to justify the concentration. Diversification is criticized as protection against ignorance, but when you are actually ignorant about whether a business model works, diversification is appropriate. Eighth, the best investors know what they do not know. Son's genius with Alibaba did not transfer to understanding food delivery, real estate, logistics, robotics, or dozens of other sectors the Vision Fund invested in. Great investors stay within their circle of competence or develop expertise before deploying capital. The Vision Fund assumed that understanding technology generally was enough to evaluate specific business models. It was not. Ninth, culture and character predict outcomes. Every major Vision Fund failure involved founders with character flaws or cultural dysfunctions that were visible before the investment. Newman's narcissism. Kalanick's aggression. The warning signs were there. Great investors pay attention to culture and character because business is ultimately about humans making decisions under pressure. If the humans are not trustworthy or capable, the business will fail regardless of the market opportunity. 10th, success in one era does not guarantee success in another. The conditions that made Son successful with Alibaba were specific to that moment. China in the late 1990s was a unique opportunity. Jack Ma was an exceptional founder. The combination was rare. Trying to replicate that success by deploying massive capital into dozens of companies in mature markets in the late 2010s was not the same bet. The context had changed even if Son's philosophy had not. For founders and company builders, the SoftBank story offers different lessons. First, taking capital from the wrong investors can destroy your company. WeWork would probably still exist as a moderately successful small company if Newman had not taken SoftBank's money. The capital enabled scaling bad business models, creating liabilities that became impossible to service, ultimately destroying the company. Sometimes less capital is better because it forces discipline. Second, governance protects founders as much as investors. Newman's total control through supervoting shares meant nobody could stop him from making terrible decisions. If WeWork had better governance, the board could have intervened earlier, limited the bad behavior, potentially saved the company. Founders who insist on unchecked control often destroy themselves. Third, growth without unit economics is suicide. DoorDash, Uber, WeWork, and many other Vision Fund companies scaled rapidly while losing money on every transaction. The bet was that scale would eventually create profitability. Sometimes this happens, but usually it does not. If the unit economics do not work at small scale, they probably will not work at large scale either. Fixed costs decline with scale, but variable costs do not, and if you are losing money on every order or ride or lease, doing more of them just increases total losses. Fourth, mission matters but execution matters more. Many Vision Fund founders had grand visions of transforming industries. Most failed because they could not execute. Vision without operational excellence is just dreaming. Great founders combine both, knowing where they want to go and being capable of building organizations that can get there. Fifth, sustainable businesses are more valuable than inflated valuations. A company worth $10 billion that is profitable and growing steadily is better than a company worth $50 billion that loses billions annually and might collapse. The high valuation feels good temporarily but creates expectations that are impossible to meet, leading to down rounds, layoffs, destroyed morale. Building sustainable businesses rather than chasing valuations is better for everyone long term. For society and policymakers, the SoftBank story raises important questions about capital allocation and market structure. First, should sovereign wealth funds be allowed to invest in private technology companies at this scale? The Saudi and Abu Dhabi money came with no meaningful oversight of how it was deployed. The returns have been poor, meaning these countries would have been better off investing in public markets. But the damage to technology industry from inflated valuations and enabled bad behavior affected everyone. Second, should there be limits on how much capital can flow into individual private companies? WeWork raised over $20 billion before going public, essentially all from SoftBank. This created enormous distortions. The company could operate indefinitely without proving its model worked because it had access to seemingly unlimited capital. Competitors who might have run better businesses could not compete because they could not match the subsidies. Markets normally force discipline through capital constraints. When one investor removes those constraints, market discipline breaks down. Third, should there be more transparency requirements for large private companies? WeWork operated for years losing billions without public disclosure of its financials or governance. Employees, landlords, and customers made decisions based on incomplete information about the company's viability. By the time the S1 revealed the truth, enormous damage had been done. Perhaps companies above certain size thresholds should face disclosure requirements even if private. Fourth, what is the appropriate role of capital in technology markets? The Vision Fund's strategy of using capital as a weapon to achieve dominance raised questions about whether this was value creation or just aggressive competition funded by investors willing to lose money. Food delivery companies subsidized meals below cost for years, training consumers to expect unrealistic prices. Ride-sharing companies paid drivers more than they charged riders, creating unsustainable expectations. When the subsidies ended, did these companies actually improve consumer welfare or just temporarily redistribute wealth from investors to consumers? Fifth, how should we think about the concentration of power in mega funds? The Vision Fund at its peak had investments in over 100 technology companies spanning every major category. This created conflicts of interest, competitive concerns, and questions about undue influence. Should regulations limit how much of an industry one investor can own? Should there be restrictions on investors funding direct competitors? The SoftBank story also illuminates broader themes about human nature and decision-making. Son's journey from poverty to becoming one of the world's richest men to losing $70 billion to rebuilding to destroying billions more reveals patterns that apply beyond investing. First, early trauma can be both a driver of success and a source of later problems. Son's experience of discrimination and poverty gave him hunger and drive that fueled his early success. But it also created insecurity and need for validation that contributed to his later excesses. He needed to prove he was the greatest investor, to show that his vision was correct, to be recognized as a genius. This psychological need led to decisions that destroyed value. Second, success creates overconfidence that leads to failure. After Alibaba, Son believed his instincts about founders and markets were infallible. He stopped listening to skeptics, dismissed concerns about valuations or governance, trusted his gut over systematic analyses. This overconfidence was rational in some sense because his instincts had worked with Alibaba. But one success, even a spectacular one, does not prove a method is correct. It might be luck. The only way to know is through repeated trials, and Son did not wait to accumulate enough evidence before deploying at massive scale. Third, conviction is necessary but not sufficient. Investors need conviction to make contrarian bets that generate outsized returns. But conviction without verification is just stubbornness. The Vision Fund had enormous conviction but insufficient verification that its theses were correct. It confused confidence with correctness, believing that certainty about an outcome made the outcome more likely. Markets do not work that way. Believing something does not make it true. Fourth, intelligence and vision do not guarantee good judgment. Son is clearly intelligent, able to process information quickly, recognize patterns, understand technological trends. But intelligence without judgment leads to mistakes. Judgment requires temperament, emotional regulation, ability to consider alternatives, willingness to admit error, calibration of confidence to actual knowledge. These traits are different from intelligence, and Son's intelligence sometimes worked against good judgment by making him overconfident. Fifth, the traits that make someone successful in one context can be liabilities in another. Son's aggression, risk tolerance, conviction, and speed were assets when building SoftBank from nothing and when making the Alibaba investment. They were liabilities when deploying the Vision Fund because that situation required patience, discipline, systematic process, and skepticism. Knowing which traits to emphasize in which situations is crucial, and Son did not adjust his approach as contexts changed. Sixth, sunk costs cloud judgment. SoftBank's decision to invest more in WeWork after the IPO failed was driven by unwillingness to accept losses on the previous $10 billion invested. But the previous $10 billion was gone regardless of what happened next. The only question was whether the next $5 billion would be well spent. It was not, but Son could not think clearly about this because he was trying to recover past losses rather than evaluating the next investment on its merits. Seventh, leverage makes people do stupid things. When SoftBank was leveraged, it could not afford to be patient. It needed to deploy capital to earn returns to service debt. It needed to exit investments to raise cash when margin calls came. These pressures force suboptimal decisions. Operating with equity rather than debt creates flexibility to wait for good opportunities, to hold winners, to think long-term. Debt destroys that flexibility. Eighth, narrative and reality diverge over time. The narrative about SoftBank and Son was that he was a visionary technology investor who understood the future better than anyone. This narrative was based on Alibaba's success and Son's eloquent pitches about AI and technology transformation. The reality was that most of his investments failed and the Vision Fund destroyed value. But the narrative persisted long after the reality changed because narratives have momentum and people want to believe in genius investors. Ninth, networks and relationships matter but are not sufficient. Son had access to everyone. Founders wanted his capital. Sovereigns wanted his expertise. Tech CEOs sought his advice. But this access did not prevent bad investments because access is not the same as judgment. Knowing everyone does not mean you can evaluate them accurately or understand their businesses deeply. Son's network was an asset but not a substitute for rigorous investment process. 10th, legacy is determined by the full body of work, not the best highlight. Son will be remembered for both Alibaba and WeWork, for both visionary successes and catastrophic failures. The question is, which matters more? Did the Alibaba success justify the Vision Fund failures? Did the value created outweigh the value destroyed? These are subjective questions, but they will define how history judges Son and SoftBank. Looking forward, SoftBank's future is uncertain. The company has valuable assets in ARM and remaining stakes in successful portfolio companies. It has a telecommunications business generating steady cash flow. It has brand recognition and relationships in the technology industry. But it also has a track record of value destruction, a conglomerate structure that trades at a persistent discount, limited trust from investors and founders, and a controlling shareholder in Son who is 70 years old and has not articulated a clear succession plan. The most likely path is that SoftBank continues operating as it has, making investments through Vision Fund vehicles, managing its existing holdings, slowly selling assets to return cash to shareholders or reinvest. The pace of new investments has slowed dramatically from the peak Vision Fund years. The check sizes are smaller. The due diligence is more thorough, at least somewhat. The leverage is lower. These are improvements, but they also suggest that the ambition has diminished. Son's original 60-year plan called for passing the business to the next generation in his 60s. He is now 67 and no successor has been named. The company's board is dominated by insiders and longtime loyalists. There is no clear mechanism for leadership transition. This creates uncertainty about whether SoftBank will outlive its founder or whether it will be broken up and sold for parts after Son is no longer able to lead. The alternative possibility is that SoftBank executes a dramatic strategic shift. It could sell or spin off the telecommunications business, focusing purely on being an investment company. It could return capital to shareholders rather than investing in new deals, essentially becoming a self-liquidating vehicle that distributes the value of ARM and remaining portfolio holdings over time. It could merge with another company or be taken private. All of these options have been discussed by analysts and investors, but none has been executed. What seems least likely is that SoftBank rebuilds trust and credibility to the point of raising another mega fund from external investors. Vision Fund 1's poor returns have made limited partners unwilling to commit significant capital again. The sovereign wealth funds that backed the first fund have not committed to later funds. The technology industry has moved on, with other mega funds like Tiger Global and Coatue deploying capital into late-stage companies. SoftBank is no longer the only game in town for founders seeking nine-figure checks. The Vision Fund's impact on the broader technology industry will be debated for years. On the positive side, the capital helped numerous companies scale faster than they otherwise could have, bringing products and services to consumers sooner. Companies like DoorDash, Slack, and others used Vision Fund capital to expand geographically, develop new products, and compete against well-funded rivals. Some of these companies created genuine value for users and shareholders. The capital also helped popularize new business models and technologies. Before the Vision Fund, it was difficult for companies in certain categories to raise the amounts needed to achieve scale. Food delivery, logistics, PropTech, autonomous vehicles, all required enormous capital investment before becoming profitable. The Vision Fund showed that this capital could be raised, encouraging other investors to deploy into these categories and enabling more experimentation. On the negative side, the Vision Fund inflated valuations across the technology industry, creating distortions that harmed everyone. When one investor is willing to pay 20 or 40 or 60 billion for a company, other investors feel pressure to pay similar amounts or risk losing deals. This bid up prices for all companies, making it harder to generate returns and creating expectations that could not be met. When the bubble popped, thousands of employees lost jobs, investors lost money, and founders saw their companies shrink or fail. The focus on growth at any cost, subsidized by the Vision Fund's capital, trained consumers and businesses to expect unrealistic prices and service levels. Ride-sharing for less than the cost of operating a vehicle. Food delivery for free. Office space at below-market rents. These were not sustainable, and when the subsidies ended, demand fell sharply. Companies had built business models around unsustainable customer acquisition and retention, creating fundamental problems that persist years later. The Vision Fund also enabled bad corporate behavior by backing founders with insufficient oversight. Newman's excesses at WeWork were funded by SoftBank capital. Kalanick's aggressive tactics at Uber were enabled by the financial cushion SoftBank provided. Other founders learned they could behave badly and still access capital if they told the right story and projected the right vision. This corrupted the culture of entrepreneurship, suggesting that charisma mattered more than character and that rules could be broken if you were building something important. Perhaps most concerning, the Vision Fund's approach of using capital to achieve dominance rather than building better products represented a philosophical shift in how technology competition worked. Historically, technology companies won by having superior products, better technology, smarter strategies. Capital was necessary but not sufficient. The Vision Fund's model suggested that capital itself could be the competitive advantage, that you could win by outspending competitors even if your product was not meaningfully better. This commoditized innovation and shifted competition from building to spending. The long-term effects of this shift are still playing out. Many technology categories now require hundreds of millions or billions to compete because that is what the Vision Fund established as table stakes. This raises barriers to entry, reducing competition and innovation. It favors companies that can access large amounts of capital over companies that have better ideas. It makes the technology industry more dependent on a small number of mega investors who can write nine-figure checks. This concentration of power in capital providers rather than operators or innovators may not be healthy for innovation over the long run. The story of SoftBank and the Vision Fund is ultimately a story about limits. The limits of vision without execution. The limits of capital without discipline. The limits of conviction without verification. The limits of speed without thoroughness. The limits of ambition without constraint. Son pushed past all these limits, believing that his vision and the scale of his capital could overcome any obstacle. Sometimes he was right, as with Alibaba. More often he was wrong, as with most of the Vision Fund portfolio. The tragedy is that Son's core insights were correct. Technology would transform everything. The winners would be enormously valuable. Backing exceptional founders in huge markets at the right time could generate generational returns. AI would be transformative. These were all true. But the execution of these insights through the Vision Fund was flawed in ways that turned correct macro views into incorrect micro decisions. If Son had deployed the $97 billion over 10 years instead of 18 months, the returns would likely have been much better. More time would have allowed better diligence, more selective investments, lower valuations, less competition to deploy. If the fund had been $30 billion instead of 97, it could have maintained standards and discipline rather than needing to deploy billions per quarter. If Son had stuck to early-stage investing where he had proven skill rather than late-stage where he did not, the portfolio would have performed better. But these were not the choices made. Son wanted to move fast, deploy at scale, make a historic impact. He wanted the Vision Fund to be remembered as the greatest technology investment vehicle ever created. Instead, it will be remembered as a cautionary tale about the dangers of too much capital deployed too quickly with too little discipline. The gap between aspiration and execution, between vision and reality, between what Son wanted to create and what was actually created, that gap is the story of the Vision Fund. For investors reading this story, the lessons are clear. Have a strategy but adapt it to context. Do the work even when you are confident. Understand what you are good at and stay within those boundaries. Manage risk through position sizing and diversification. Avoid leverage that forces your hand. Take profits when they are available rather than hoping for more. Learn from failures faster than you celebrate successes. Question your assumptions constantly. Surround yourself with people who will tell you when you are wrong. Remember that in investing, the goal is not to be brilliant but to avoid being stupid. For founders reading this story, the lessons are equally important. Choose your investors carefully because capital is not neutral. Make sure your business model works at small scale before trying to achieve large scale. Build governance structures that protect you from yourself. Focus on creating value for customers rather than extracting value from investors. Be honest about what you know and do not know. Avoid mission statements that cannot be executed. Remember that companies are built by teams over years, not by individuals with visions. For society, the lessons are about the role of capital in shaping outcomes. Markets are supposed to allocate capital efficiently to its best uses. But when concentrated pools of capital deploy at massive scale without discipline, they create distortions that harm efficiency rather than improving it. The regulations and norms that govern capital allocation matter for outcomes. The transparency required of companies, the governance standards expected of founders, the oversight of how sovereign wealth is invested, all affect whether capital creates value or destroys it. The SoftBank story is not finished. Masayoshi Son is still leading the company. The Vision Fund still has dozens of investments that have not exited. The long-term outcomes are not yet known. But enough time has passed and enough evidence has accumulated to draw preliminary conclusions. Son's success with Alibaba was real and remarkable. His failures with the Vision Fund were equally real and equally remarkable. He demonstrated both vision and recklessness, both brilliance and blindness, both extraordinary capability and extraordinary fallibility. In the end, the question is not whether Son was a genius or a fool. He was clearly neither and both. He was a human being with exceptional abilities and significant flaws, operating in contexts where sometimes his abilities mattered more than his flaws and sometimes the reverse. He made one of the best investments in history and some of the worst. He created enormous value and destroyed enormous value. He demonstrated that conviction and capital can achieve remarkable things and that conviction and capital can destroy just as remarkably. The distance between triumph and disaster in investing is often smaller than it appears. The same qualities that produce one can produce the other. The same strategies that work in one context fail in another. The same person can be both right and wrong, both successful and unsuccessful, both hero and cautionary tale. This is the paradox of investing and the paradox of Masayoshi Son. Understanding both sides of that paradox is essential to understanding what happened with SoftBank and what lessons we should draw from its story. As we close this documentary, we are left with questions more than answers. Could Son have achieved his vision with different execution? Will the remaining portfolio ultimately vindicate the strategy? What happens to SoftBank after Son? Did the Vision Fund change technology investing permanently, or was it an aberration? How much value was truly created versus how much was transferred or destroyed? These questions will be debated for decades. But what is clear now is that the SoftBank Vision Fund was one of the most significant experiments in technology investing ever attempted. It tested the limits of capital, scale, speed, and conviction. It showed what happens when almost unlimited resources are applied to a thesis about the future. It demonstrated both the power and the peril of concentrated belief and concentrated capital. The story matters because it teaches us about investing, about technology, about markets, about human nature. It shows that even the most successful investors can fail spectacularly when they stop learning and start believing their own mythology. It shows that capital is powerful but not omnipotent, that it can accelerate but cannot create, that it can enable but cannot guarantee. It shows that the context in which a strategy is applied matters as much as the strategy itself. Most importantly, it shows that there are no permanent winners in markets. Every success contains the seeds of future failure. Every failure contains lessons for future success. The cycle continues, capital flows from winners to losers and back, strategies that worked stop working and new strategies emerge, the confident become humbled and the humbled sometimes find confidence again. Masayoshi Son's story is not unique in this regard. Every great investor eventually faces markets that do not care about their past success. Every visionary eventually encounters realities that do not match their vision. Every period of triumph eventually gives way to periods of challenge. The question is not whether this will happen but how people respond when it does. Do they learn and adapt? Do they persist stubbornly? Do they give up? Do they blame others or take responsibility? Son's response to the Vision Fund's failures will define his ultimate legacy as much as his successes. So far, he has acknowledged mistakes while defending the overall strategy. He has slowed deployment while continuing to invest. He has reduced leverage while maintaining conviction. Whether this represents true learning or merely tactical adjustment remains to be seen. The next chapter of the SoftBank story is still being written, and only time will reveal how it ends.